Hi, I'm Nehemiah Richardson from Pengana Credit. For those of you who aren't aware, we run a multi-manager, multi-strategy global private credit fund where we invest in managers who are at the coalface of the economies in both the US and in Europe, lending money to mid-market corporates and mid-market non-bank lenders in structured finance. From that vantage point, I thought it would be useful to give you a perspective of what we've actually been seeing in both the US and European markets over the last 6 to 9 months, because we still have quite a significantly evolving set of circumstances in those markets. So if I go back to halfway through last year and through the second half of last year, we went from having lots of dislocation, lots of conservatism, lots of uncertainty about what was actually going to happen in the economic environment going forward, and in particular what was going to happen with interest rates given the inflation genie hadn't yet been put back in the bottle. As we went through the second half of the year, certainty started to return in terms of we're actually reaching the end, and sentiment returned towards, and conviction towards we're at the end of the interest rate rise cycle and things should therefore normalize a bit. And from that, what has happened has been a significant increase in economic activity, particularly in the US, to some extent in Europe, which has actually then driven transaction volumes, both from an M&A perspective, because the M&A market started to come out of the doldrums, as well as demand for credit across all of our managers. And so what that's actually meant is for the global private credit space in both the US and Europe as a proxy for what's happening in the underlying economy, a lot more confidence to invest, a lot better understanding of what the valuation environment actually looks like going forward. And so companies actually having the confidence to start to invest. What that then has meant is very significant activity, origination activity actually happening in the private credit space across all of the strategies that we actually see, which has been pleasing for both our managers, and I think pleasing for the economies. Where I would now, just to close off with, is to say, whilst there is more confidence, credit managers are still very, very vigilant, because it's not really clear whether we really have met a soft landing or whether there's going to be a hard landing. But the positive thing about being in private credit with the managers that we invest in is they tend to invest in very defensive industries that have really clear line of sight of their future cash flows, because in debt you want to get paid back, and because in their senior part of the capital stack with low LVRs between 30 to 40%, with really nice structural protections in the way they invest, they're kind of agnostic as to really what happens in the economic environment. They're very confident to be supporting the companies that they do, and they're feeling very optimistic that this growth and in confidence and volumes will continue.